Hi there, welcome to Markets Tomorrow right here on 18 on the Mumbai News Centre. I'm Tanveer Gill. Start off with a quick roundup of all the top headlines that we are following at this hour on the show. To sum up how the markets fared, it was a strong comeback in today's session, and Nifty edges past the crucial 8250 mark. Metals led the rally while all constituents of the Nifty Bank Index ended in the green. Tata Motors was up on robust sales data. The automaker's British subsidiary JLR notched up a whopping 30% growth in US sales for the month gone by. CLSA's bullish view cheered Vedanta in trade. The global brokerage placed its bet on the metal giant, expecting to deliver strong volume growth over the next 2 years, driven by ramp-up in its new aluminium and power capacities. Sales surged in trade after it reported a 16% sales growth during the April-December period over the corresponding period last year. Improved sales led by higher domestic sales and robust exports. Sorry about that. ET now gets you a peek into Form 483 issued to Aurobindo Pharma's unit. The US FDA raised as many as 4 observations post-inspection in September 2016. However, the drug regulator doesn't mention any data integrity issues. That's an ET now exclusive. Meanwhile, investors hit the sell button on Fortis after reports suggested that the Singh brothers are in talks with KKR for selling its stake. The PE giant is looking to buy a majority stake in the hospital chain, the deal being valued at around 3,000 crores. Just Dial surged 14%, its sharpest intraday gain in the past 10 months. On the back of heavy volumes, the search engine will consider demerger of Just Dial Global on the 17th of this month. We will make sense of the markets as always with voices lined up on the show. Prashant Jain, the CIO of the largest mutual fund in India, HDFC, will be talking about his investment ideas and his investment thesis for 2017. Amar Singh of Regional Broking will be highlighting his views. And Rohit Agarwal, equity fund manager at Kotak Life Insurance, will also be talking about how to approach trade in the near term. Let's address the question of the day first. After the Nifty had a touch and go with the 200-day moving average at 82.75, the question that we are asking is, will the Nifty be able to break out of that mark? So far it seems like the index has put a support in place, which is at 8,000. And this was around New Year's time, in the countdown to closing out 2016. And from there, we've been slowly building the gains. Are past 82.50, but it remains to be seen whether a decisive breakout, which just takes the market into a zone, signaling a firm uptrend, whether that breakout comes by. Rohit and Amar, good evening to you. Amar, I'll start off with you first. What is it that you're seeing on the charts to signal the market's direction from here?
Yeah, overall, the pullback was on expected lines because if you're looking at the markets on a technical perspective, from a short-term as well as a medium-term perspective, markets were technically oversold. So there was this short covering that had to happen, and also the earlier low of 79.16, 79.20 which was there. The markets did manage to breach that level, but again it closed higher above 7,900 level. So somewhere or the other there was buying coming into it, and also there was short covering. So we've seen a significant rally, almost you can say roughly 400 points a move from there. And currently Nifty is around 8270, 8280 the range. So, on the upside, we see that Nifty could meet with selling pressure or resistance somewhere around 8320 to 8350. That could be a level to watch out for. Yes, it has been a sharp rally, so we'll have to see whether it sustains above that level. And also technically speaking, on the medium term, intermediate term charts, the markets are not likely to go up in a hurry. So there would be some selling pressure also coming around, as I said, around 8330 to 8350 levels. So yes, but the downside definitely seems to be a bottom seems to have been made, which should hold, and the markets could then trade sideways for some time till fresh positive triggers are there in place.
Yeah, Rohit, come to you, and do you also echo the same view in terms of the directional uptrend for the market being resumed once we actually break out of this range?
Hi, good evening. We do not necessarily subscribe to that kind of a very short-term view. But having said that, if you closely look at what's happened in the month of December, the Indian equity markets have actually underperformed almost every other emerging market. So when we say that the bottom is in place, it is also to be looked at in the context of what's happening relatively. We have already underperformed relatively to the emerging market peers. Now what's happening is probably that the market participants are done or are almost going a little slow on the demonetization related selling, or also the global commodity rally or the global dollar rally related selling. Now it is very true that if we saw today itself that the dollar reversed some of its gains, and what will be interesting to watch is what is the kind of FI numbers that you see at the end of the day. Now we have seen relentless selling by the FIs mostly in cash markets in the last 1.5 months or so. More so even in December it continued, albeit the pace reduced a bit in the last 10 days, and in the starting month of Jan it again has not been very high, although it was high in the last couple of days. So you'll have to watch out what happens to the flows. I think when we say that the bottom has been formed, it seems to have been formed, but it can be very short term because markets as of now are looking for directions. The directions will come from two avenues. The first avenues will be the result season, which is going to kickstart in a couple of days or so, and then the market is keenly awaiting the budget. If you take aside all these two factors, then of course India has relatively underperformed. That needs to be kept in mind. If the FIF flows reverse at the margin and the DIF flow, which has been positive, and the DIF flow continues because the mutual funds and the insurance funds are getting money, even keeping the same level of percentage of cash, the incremental money will have to be deployed into the markets. If that happens, markets will likely get some sort of support. And let's not forget that the Jan-March quarter is a very, very heavy quarter for the insurance sector. They almost see 60 to 70% of their inflows in this quarter itself. Hence, if things go alright, you will see a lot of buying coming in even from the insurance funds, I believe.
Okay, fair enough. We want to just very quickly get in some thoughts on what brokerages are making of this rally, and particularly the move in select sectors, especially metals. Mubina joins in to talk about how CLSA believes metals will continue to shine in 2017 as well. It's an extended trade, but if one were to look at the metals rally in 2016 as a mere correction of the kind of sell-off and crash that these very stocks witnessed in 2015, then perhaps this theory holds ground. Mubina, what is CLSA specifically talking about to be the reason for the upside?
Oh yes, CLSA has come out with quite a positive note on the metal space. They say that the healthy returns that we have seen in some of the Indian metal companies will continue in 2017 as commodity prices are likely to improve, and most of the companies do have a couple of strong catalysts as well. They are going to see healthy deleveraging as well occur this year. Now they believe that most of the Indian companies will follow through to that healthy volume growth that we have seen in 2016. JSW, Steel, Vedanta, all of them did put in some very strong earnings because of volume growth. So that is going to continue in 2017. Vedanta, that's their top pick for 2017. We did see the stock rally as well today in trade, followed by Hindalco and Tata Steel. They have rated JSW Steel as an outperform, and Coal India is the solitary sell within the space.
Right. What do you make of what's happening with metals, Rohit? And do you also think that this is a case that will hold ground, where one sees now perhaps more than last year a structural move which will support prices?
Well, we believe that metals and commodities do not necessarily warrant a structural kind of a theme or a call, simply because they are too volatile and they are too dependent on too many moving parts. If you look at what's happening around the world, a lot of the rally has been fueled by what's happening in China and what's happening in the US. Now it does not take too long for things to reverse. Most of the participants believe that the crude is probably capped at 60, and if we were to believe that the dollar continues to rally, then you will see having pressure in the US itself in terms of their exports. Say the car makers in Detroit, they will get into some trouble for sure. What is happening is, in China, people say there is a lot of stocking going on, whereas there was a lot of destocking earlier. At the same time, we have to keep in mind that China is also closing down or clamping down on a lot of commodity producers because of the environmental concerns or the hazards that it carries at large to the Chinese economy. So you'll have to, it's really a very fine balance, and it's something that you have to really look forward and look into as per data points. But yes, you could say that it is probably unlikely that in the near term the commodities will go back to the same lows that we saw in the last year. Having said that, it does not necessarily mean that the commodities are on a structural upturn. In fact, we believe that it may not be so, simply because for a structural upturn you need all of the global economies to fire. The US economy is tugging along just fine, but it is not something which is rollicking or which is rocketing up and growing at 4%. The Euro region is still struggling, Japan is still struggling, even China is still struggling with its growth. So unless global GDP growth goes to 4% or higher, you do not necessarily make a structural case for commodities to go up. So you have to really watch the data points, and India being the brighter spot, which is likely to grow a little higher than some of the regions that we talked about, will not be a big consumer of commodities to move the needle. So we do not necessarily believe that there is anything structural. But what's happening is in some of the companies that you have mentioned right now, there is a difference that some of the companies have got some allocation of mines regarding coal, so their cost of production has come down. So there's a difference between global commodity prices and how the Indian companies or a couple of the companies may behave, simply because their fundamentals have changed. What happens is when the markets go down and the things are not good for commodities, even these little things or changes which happen at the margin in these companies, which is basically good for the balance sheet, because if you get a linkage for coal, your reliance on imported coal goes down, your reliance on outside world goes down, your balance sheet gets healthier. And also, let's not forget that these companies are highly leveraged, and with the interest rates coming down, there is a benefit that straight away flows through their P&L and hence their balance sheets. And hence you see the re-rating happening in some of these companies. It is not necessary that the re-rating has happened just because the commodity prices have gone up. If you actually look at the commodity prices in the last month or so, they haven't really moved. In fact, if you look at zinc and aluminium, even copper, they've actually retreated from the highs that they had seen last year.
No, fair enough, and I'm glad you explained that thought process of yours for the entire metals basket. It is really boiling it down to specific names and specific companies where perhaps the fundamentals are changing. CLSA is of course talking about how they're bullish essentially on JSW Steel, which is an outperformer, and they have a sell on Coal India. However, their top pick continues to be Vedanta, followed by Hindalco and Tata Steel, which have been the top performers from the space through the course of 2016. We'll take a break right now. As we do so, hear out India's top fund manager Prashant Jain outline his top strategy for this year.
Yeah, yes, to target double-digit returns, I think equities are probably the only meaningful option today. And the only sector I think which will have to change the way it does business is non-banking financial companies. Because POS transactions and POS machines are going to become a way of life. And once POS is established, even both in the small establishments and larger establishments, it is already there. It would be a significant competitive advantage for the banks. And so that is, I think the banks are gaining competitive advantage at the cost of NBFCs.
This Mr. Prashant, the argument is that, okay, I may have a great liability franchise, but I am not in the business of collecting deposits. I also have to lend intelligently. And for me to lend intelligently, there has to be an offtake, which is not there.
Yes, so you are right. For the current year, the credit growth is much less than what was earlier envisaged. But I don't think the situation will remain like this for
Why do you say
ever. Because retail is growing, retail continues to grow. On the capex side, we are seeing good action, good movement on the roads. Railways, you will see current year itself, there is very good progress, and that should continue to gain momentum over the next 2 years. In power T&D, I think things continue to look quite good. The private capex is still weak.
So are you confident that business and earnings will revive for large cap IT?
I think the sector remains very competitive, globally competitive, and I think it should grow over time, because IT, the way business is being done across the world, is changing very fast. I mean, technology is becoming integral to every business. So what do you do when technology is becoming integral?
You not change your view on IT and pharma, or have you? Because this price rise correction has kicked in.
I think pharma we have not been very positive, and I think price correction has taken place. Multiples have contracted, but still they are, I think, not in the zone where I would say that they offer great value. If you look at market cap to GDP in India, we are trading near all-time lows of market cap to GDP, but PEs are not close to all-time lows, and the reason is because corporate profitability is still near a cyclical bottom. I think over the next 2 years we should see improvement in aggregate profitability, and earnings will catch up.
Welcome back. You're still watching Markets Tomorrow right here on ET Now, and we are still in conversation with Rohit Agrawal of Kotak Life Insurance and Amar Singh of Angel Broking. And I just wanted to get a quick sense from you, Rohit, on how you're approaching the pharmaceutical sector. Is there buying interest there, given the kind of sell-off we've seen through 2016 in the space? Also, the other one where the market is circumspect, which is IT.
Sure. If you actually look at the pharma sector, as you said, rightly said, that 2015 pharma sector, you have seen almost most of the stocks having given up a lot of the gains that they had seen during the 2012 to 15 rally. Now if you see what's happened is, a lot of this give up has happened due to 2 or 3 reasons. One and the foremost reason is that the earnings expectations of these companies have been cut. So although you have seen an absolute decline in the prices of the pharma stocks, it has not necessarily resulted into an absolute PE decline or the forward metric that the market looks at in these pharma stocks. Having said that, most of these companies are starting to find their ground and starting to come out of the issues that had plagued them in the last 1.5 years or so. But pharma has always been a bottom-up sector. So you have to be very selective in the kind of stocks that you select in pharma. In pharma, we believe that the companies who have a lot of exposure to the US, but at the same time who are in the sweet spot of $100 million to $300-400 million of business in the US, are the companies where you will probably see returns getting made, because as companies hit the $1 billion sales in the US, it becomes very, very difficult for those companies to grow. We have seen this in the case of 3 largest Indian pharma companies, where getting close to $1 billion is something they achieved in the last decade or so, but after that there has been a struggle, and they are having to reinvent themselves or trying to find new ways to grow from that large base. So you have to be really selective. There are companies in the mid-cap space or companies which have till now not been able to focus on the US, or for some reason the US policy has not worked well.
Right.
If you look at the IT sector,
No, we just completely out of time, Rohit, so I'll take your point on pharma and we'll leave IT for next time. Amar, very quickly, can you help our viewers with strategies for trade tomorrow?
Yeah, the first one is United Phosphorus. So United Phosphorus can be a buy at 670 levels with a stop loss of 664 and a target of 682. The next is on the IT space, Ramco Systems. Ramco Systems can be a buy at 380 levels with a stop loss of 369 and a target of 397. And the third is also a buy in the IT space, and that is Hexaware. So one can look at buying Hexaware at 208 levels with a stop loss of 204.80 and a target of 215.
All right, Amar as well as Rohit, thanks very much for taking out the time to speak with us today and make sense of the markets. That's time out on Markets Tomorrow. Catch you with the markets as always tomorrow morning at 8 a.m.